BlackRock is, of course, the largest asset management company in the entire world with nearly $10 trillion of assets under management. That's about 3 times the size of all of India's GDP. How crazy is that? Anyway, under the leadership of their infamous CEO, Larry Fink, BlackRock made some giant stock purchases in the third quarter, which were just now recently released to the public. So, in today's video, we're going to take a look at the 5 largest of those, the 5 largest, most recent stock purchases that BlackRock just made. And to make it a little more fun and interesting, I'm going to give my own opinion on them and even rank them from best to worst based on my opinion, and I'll even let you know if I'd consider buying any of these stocks myself too. So it's always a lot of fun when we do these videos. Hit that like button if you enjoy them. If you want to support the channel, please subscribe. Helps keep my channel alive and it means a lot to me. But let's not waste any time, guys. Let's go ahead and jump straight into this list of 5 stocks that BlackRock is buying. All right, now we'll be counting up here from smallest to largest position in the portfolio. And so coming in at the first purchase here, it's going to be a stock that just barely IPO'd this year in Kenvue, ticker symbol KVUE, which BlackRock had basically purchased around the IPO time for the first time ever in the previous quarter, and they now decided to increase that position by a massive 1,461% in this past quarter, bringing the total stake in the company up to nearly $2 billion, and yet it's still only worth about 0.06% of the overall portfolio. So it just shows you how massive that portfolio is. But anyway, if you've never heard of Kenvue, it's actually the consumer health business that was recently spun off from the giant corporation Johnson & Johnson. And it's the owner of some of the most popular healthcare, pharmaceuticals, and beauty brands in the world, including Tylenol, Benadryl, Zyrtec, Motrin, Nicorette, Pepcid, Rogaine, Neutrogena, Aveeno, Johnson's, Listerine, Neosporin, and even Band-Aid too, and the list just goes on. Overall, the company is very large, doing over $15 billion in sales across more than 165 countries, where they hold #1 brand positions in 36 regions and launch over 100 new product innovations every single year. Unfortunately, though, you're just not going to get much growth from an already large kind of legacy company like this that relies so heavily on those already well-established brands, as their sales are only expected to rise by around 2% next year, while EPS is also expected to average about the same low amount over the next 5 years as well. And I think because of that low growth, along with a couple of lawsuits that are still underway, the stock price has now fallen by around 30% since IPOing. Normally, I'd say that that's a good time to buy in, as they have a pretty safe and reliable business for the long term, which the fall in stock price has also caused their dividend to rise up above 4%, which is pretty attractive. But with such a large drop in share price coupled with the low legacy growth, you would think that the valuation would be super attractive, like so many other pharmaceuticals out there in the market at the moment. However, in this case, Kenvue only trades around 10% cheaper than the sector on an adjusted PE basis, while GAAP numbers are actually even higher. I still think it's an okay stock overall if you're just looking for that relatively boring kind of dividend payer for the long term, but if you want a cheaper valuation, more growth, or even a bigger dividend, I think there are plenty of other biotechs available right now that can better satisfy those needs. So I'll be nice, I'm still going to rank it somewhere around the middle for now at #3 until I see what else is on this list, but it's not a stock that I'll be buying myself anytime soon. All right, moving on to stock #2 here, we have a stock that I have never talked about before on the channel, but I'm actually getting really interested in this one the more that I research it, and that is Extra Space Storage, ticker symbol EXR, which BlackRock increased their position on by over 50% in the quarter, adding another 7+ million more shares, bringing their total stake in the company up to over $2.5 billion. Now, if you've never heard of this one, they're actually a REIT, a real estate investment trust, that owns self-storage units and then leases them out to customers, which is actually a much stronger business model than you might think, as there is not not only consistent demand for storage facilities as the world grows larger and people buy more items and assets that oftentimes need to be stored in pretty much any kind of economic environment, but on top of that, they can also generate revenue from multiple different sources, as they can not only raise rent prices much easier because of their month-to-month structure, but they can also collect late fees, charge insurance, charge premiums for things like larger vehicles and boats, or even rent trucks and sell various packaging products and moving services, all of which have been a winning combination for EXR, who has now grown to become the second largest storage company in America, only behind Public Storage, with over 2.5 million units across more than 3,600 properties in 42 states, with also a very strong occupancy rate of 94%. So the company is just by all accounts on fire right now, and you can see that in their financials too, that continue to break new record highs, which, thanks to another big acquisition recently of Life Storage, EXR is expected to grow sales by another 20 to 30% in each of the next 2 years as well. But because of rising interest rates and a possible looming recession, many REITs have actually crashed over the past year in fear of a broader market meltdown. And EXR was no exception, as they too have lost over 40% of their total value from the top. And while the valuation is still a little rich compared to the sector, their price to funds from operations, which is the common valuation metric for REITs, is actually significantly lower than both their 15 and 10-year averages by around 30% each. That's pretty attractive considering the strong business and the impressive dividend, which, by the way, don't be fooled by what all the websites are showing. They're actually calculating it wrong because of the recent merger with Life Storage, but the correct dividend yield at today's prices is really high at around 5%. Guys, I'm getting pretty tempted here to buy a little bit of this stock myself, because I think I'm looking at a long-term winner here, and overall I'm going to rank them pretty high on this list at number 2 until I see what else is on it. Okay, moving on to stock number 3 though, we have a very popular kind of growth-oriented tech stock in Airbnb, ticker symbol ABNB, which BlackRock increased their position on by over 35% in the quarter, bringing it up to over $3.5 billion. Now, this is a stock that I have actually covered a few times on the channel before, but I've never been quite brave enough myself to buy it just yet. But I do keep a close eye on it just because of how popular the brand has become as one of the biggest online booking websites for home and apartment rentals. Of course, most people use it through the app. And this is a business here where Airbnb is able to collect fees from both the property owner as well as the renter. That can be very lucrative, collecting, revenue from both sides of the purchase. And overall, it's just a very attractive service that they provide that will likely always stay in high demand, as people generally like to stay in fully furnished homes for the convenience of it, especially if they're traveling with a large group of friends or family. Plus, Airbnb even offers experiences now where the host can guide you through some unique activity that may even be tied to the area that you're staying in, like for example making macarons in France or going on a hike or cruise in Greece and other stuff like that. Anyway, customers love the convenience of Airbnb. The homeowners also love that they can generate another revenue stream from them, and overall it's just led to a lot of success for the company, having already grown to more than 200 million annual users by 2020, which was the last year that they reported the statistic. So it's likely grown even larger since then. And it's also grown to close to 400 million bookings last year, which was an increase of over 30% year over year. However, the competition has also been growing, and while this chart does include booking websites that also cater to hotels, the fact is that there are many companies now offering similar services that keep growing into larger rivals, as there isn't really much of a barrier to entry in this market. Any company really is, especially even legacy players, can easily list residential homes for rent, and if they're trying to steal market share, they'll likely give huge discounts on fees to start out, which ultimately puts pricing pressure pressure on Airbnb as they have to also lower their rates in order to maintain their dominant position, which we may already be seeing at least some small signs of this as their listings have actually gone down since the 2019 high of 7 million. Even 3 years later, they were still lower than that at 6.6 million last year. I think it's a sign that competition is getting more intense. Financials have also been rocky in recent years too, though, with big losses reported in most of them. However, they did see a large recovery last year to new record highs on both the top and bottom line. And while they certainly face a lot of headwinds given the weak macro economy, where they're only expected to grow by around 10% a year on sales, the stock has at least fallen to reflect that, crashing by over 40% since around the time that they IPO'd a couple years ago, which brought the valuation down to around 20% cheaper than the sector on a PEG ratio basis. It's still too risky of a stock for me personally, and I don't like them as much as I like Extra Space Storage, but I do think that they're at least more interesting and have more future potential than something like Kenvue. So I'm going to bump that one down one spot so that I can squeeze Airbnb right in between the two at number 3. All right, that will, however, bring us now, though, to the final two purchases. And coming in at number 4, we have none other than Blackstone, ticker symbol BX, which BlackRock increased their position on by nearly 30%, bringing the total stake up to nearly $5 billion. Now, if you're not familiar with Blackstone, you might be thinking, okay, BlackRock is buying Blackstone. Those companies have to be related in some way, right? Well, yes, they are. In fact, both were founded in 1985 under the umbrella company Blackstone Financial Management before BlackRock split off in 1988 to focus more heavily on risk management and just overall, investment portfolios and various other products and services. Whereas Blackstone has grown to be the largest alternative asset manager with over $1 trillion of assets under management that particularly specializes in real estate, where they've also grown their global real estate portfolio to almost $600 billion. So really, we continue to see a trend here of BlackRock just buying up stocks here that have a lot of heavy exposure to real estate. It's pretty interesting. They're making a bet on real estate, which in the case of Blackstone, they're so large that they've even grown to become probably the most controversial player in the space, as they're often criticized by just about everyone for using their giant wealth to outbid regular home buyers and consumers who can't compete with their massive size, and then using that real estate to jack up prices on rent and houses, which is probably one of the reasons why home prices continue to break new record highs while regular consumers keep hoping that a crash will eventually happen. But even then, I wouldn't bet on that stopping Blackstone from still outbidding you, as they've also been storing up huge funds for the specific purpose of continuing to buy homes even if the economy crashes. As you can tell, I'm personally not a fan of these practices. However, if I put any personal feelings aside, I have to admit that it probably is a pretty decent stock here to invest in long term, just because of their massive size that makes them relatively low risk. However, you should keep in mind that the stock has already soared by a huge amount post-pandemic, which has driven up the valuation to now trade around 100 to 200% more expensive than the sector, which I think limits the upside potential a bit. And I feel about the same way about the dividend too. By the way, they have a little bit of a different dividend structure than other companies. They make payments based on their profits, which makes it a little more volatile than you might be used to. But currently it's yielding around 3%, which I think is a little low compared to the 5 and 10-year averages of around 4% or more. Financials can also be a little volatile, but are usually very profitable, and overall it's just going to be a hard one to rank here because it really depends on what you're looking for specifically. If you want more growth potential, then Airbnb may be a better choice, but for overall size and safety and dominance, I think Blackstone would still get the edge here. So I'm going to push it into the 3rd slot and move the others down to fit it in. However, I'm still keeping EXR on the top for now at number 2 because that's still my favorite. But finally, guys, we have the last stock of the list, which is also the largest position in the portfolio out of these 5, and that's actually going to be a pharmaceutical giant in Eli Lilly, ticker symbol LLY, which BlackRock just barely increased their position on by less than 2%. However, it was still over 1 million more shares, bringing their total stake in the company up to over $35 billion. And yeah, this one makes sense for a large fund like BlackRock to own, as Eli Lilly is a very dependable and also very large biotech, breaking new record highs on sales in most years and are currently ranked as the 12th largest in the world by drug sales. The pandemic was especially beneficial to Lilly, as their antibodies treatment was a popular choice for handling the pepperoni. However, coming off of the pandemic, it set them up for a more challenging year, as their pepperoni treatment sales have now been falling, along with a couple other key drugs that lost patent protection, namely a cancer treatment called Alimta, that recently saw their sales get cut in half because of the rise in generic competition. However, Lilly is already working to address these concerns, as their top 4 products are still posting solid growth. They've released several more new drugs this year, and all the meanwhile they continue to make new acquisitions of smaller companies, which is also bolstering up their already very strong pipeline that has tons of other new drugs that are already in phase 3 trials. As a result, sales are actually expected to rise both this year and the next by a mid-teens percentage. But because of that strong performance, the stock rarely ever dips and has already soared by over 60% this year to a new record high, which is unfortunate for anyone not already in the stock, including myself, as the valuation is now 1, 2, 3, or even 400% more expensive than the sector, depending on the metric you look at. Personally, I like investing in pharmaceutical stocks for the cheap valuation and the huge dividends, but in the case of Lilly, they're not only really expensive, but the dividend is also tiny at just less than 1%. I mean, I can't argue with the stock's performance, and I can understand why others choose to invest in it, but at today's prices, I have almost zero interest in owning this stock myself, as I think that there are much better options in the biotech space, so it's getting the worst ranking from me. And that's going to leave us with our final results, where I put Extra Space Storage at number 1, a little bit by default, but I actually really like this stock, and I may even buy some in the near future myself. Then I put Blackstone at number 2 for the large size and safety, then Airbnb at number 3 for the growth potential, Kenvue at number 4 for the attractive dividend, and finally Eli Lilly at number 5, who I just feel is really the wrong time to be buying this stock. So yeah, overall, not too excited about any of these stock pickups really, except for Extra Space Storage. I do really like that one. I might purchase it in the future, but the other stocks, if you're looking for value or growth, I do think there are better options out there in the market. So kind of a lackluster quarter here from BlackRock in terms of the moves they're making. Nothing too exciting, unfortunately, this time. But maybe next quarter will be more exciting. Let me know what you all have to say, what you think about these down below. Do you like any of these stocks? Do you agree or disagree with anything I said and with my rankings? I'd love to hear your opinion on all of that. But thanks again for stopping by, my friends. I will catch you in the next video. Take care, everybody. Bye-bye.